Hi everyone, this is Nancy Godrat. In this session, I'm going to go over the learning objective number 2 of chapter 8, how companies value accounts receivable and record their disposition. So basically, accounts receivable is a current asset, meaning that the company estimates and hopes to collect it in cash within 1 year. And the amount they're going to collect from the customers is called cash realizable value. So that's the value that the accounts receivable is going to be realized in cash. So how does this happen? It's because when the company sells merchandise on account, meaning does it receive cash right away, there is a possibility that some of or all of it from that customer will not be collected in future. So the question is that why do they extend credit to customers that they're not going to pay us? Well, the answer is that we really don't know. The company does their due diligence before they extend credit, but there are events in the future that is out of the control of the company. Remember for example, the recession of 2008, that was the time that a lot of companies could not afford to pay their receivables, pay what they owed to the other companies when they purchased merchandise and accounts. So therefore, companies who had accounts receivable had to record the amount they weren't able to collect as an expense of doing business on credit. This expense is called bad debt expense in our accounting language. Sometimes they call it uncollectible accounts expense, but in this book we're going to call it bad debt expense. So there are two accounting methods to record the uncollectible amount of accounts receivable. One is called direct write-off method. So remember, you have to see the word direct write-off to be a method. And it is not really acceptable under GAAP. So why do we go over it? Just because some companies who are not publicly accounting companies, they don't have to follow GAAP. So therefore, they follow direct write-off method, which is very simple. So what happens in this situation? Let's, if a company uses direct write-off method, let's assume as an example that we have a company, Warden Company, and once they know who is not paying, which customer is not paying their receivable, so they have to wait until they know which customer is not paying. At that time, they're going to take off that receivable off the books, which is called a write-off. So therefore, at that time, they debit bad debt expense and credit that accounts receivable. So that's easy. However, this is not matching the revenue they had from selling on account. Let's say they had that revenue last year. This year, they're writing off what they know is uncollectible. So there is no matching between revenue and expenses. This could even happen in 1 month. So in 1 month, we sell merchandise on credit, and for that month when we prepare financial statements, the revenue shows up as 200, but the next month we're writing it off because the customer doesn't pay. So therefore, we didn't match the expense and revenue in one period. So, and the receivable of 200 is not really stated at how much we estimate to collect in the future. So it's not acceptable under GAAP. The other method, which is acceptable and required by following generally accepted accounting principle, is an allowance method. What does allowance mean? It is an estimate for how much of the accounts receivable will be uncollectible. So it is better matching revenue with expenses, and we are recording the cash realizable value of the accounts receivable in our financial statements in the balance sheet. So let's go over a way that the accounting for recording this type of bad debt under the allowance method. Again, the cost of uncollectible, cost of doing that business on credit, selling merchandise on credit and not collecting it, is called bad debt expense. Since it is an expense, we always debit it, because that's how we increase expenses. However, we cannot credit the accounts receivable, because when we estimate how much of the receivables will not be collected, we really don't know which customer is not paying us. We're just estimating that based on our last experience. For example, a percentage of our customers in the past haven't paid us, so we're going to also use that percentage to say that we're not going to receive the cash. That, instead of crediting the accounts receivable, since we don't know which customer will not pay us in the future, we create a new account called allowance for doubtful accounts. So we are estimating, putting aside an amount for the future uncollectibles. What type of account is allowance for doubtful account? It's a contra asset. It's contrary to accounts receivable. It's reducing accounts receivable in the general ledger. They show up next to each other. First, accounts receivable T account, next allowance for doubtful account. And so this, we're gonna debit bad debt expense, credit allowance for doubtful account. We're going to go over number 3 in a second. So let's, for example, for illustration purposes, say that Hampson Furniture has a credit sale. They sold merchandise on credit for $1.2 million in 2019. However, in 2019, $200,000 of it, the credit sales, remains uncollectible, meaning they hope to collect it in the future. So that's the ending balance for accounts receivable. Now, the credit manager, based on the past experience, knows that some of those customers in the amount of $12,000, they're not going to pay their obligation. So we have to make an adjusting entry, debiting bad debt expense for the $12,000 estimate and crediting allowance for doubtful account for $12,000 under the allowance method. Now, how do we show it in the balance sheet? So under the current asset, we show the $200,000 ending balance, and right below it, we can show how much we expect to not collect in future. So the $188,000, the difference between $200K and $12K, is how much we will estimate to collect in cash. It's called cash realizable value. Sometimes cash realizable value is called net realizable value. Now, some companies might just show the net accounts receivable as $188K, so they don't go through these two steps. They just show the accounts receivable net of allowance being $188K. That's acceptable too. Now, what happens if eventually next year the company realizes that a customer who owed $500 will not be paying this balance? So now, since we set up an allowance, we're going to take out that $500 out of allowance for doubtful account. So we're going to debit allowance for doubtful account. And since we know which customer is not paying us, we're going to credit the accounts receivable for that customer. So now the ending balance as of March for accounts receivable is 199,005, and the ending balance for allowance for doubtful account is 11,500. Now, what happens if on July 1st, the company that owed us 500 and we wrote off their balance due to their bankruptcy comes back and says, you know what, I can pay you $200 of what I owed. So in this case, we always have two journal entries. We reverse the original entry to the extent of collection. So we're going to debit accounts receivable, credit allowance for doubtful account, and then like every other time that we collect cash from customer that owed us, we debit cash and credit accounts receivable. But remember, this is to the extent that we're going to collect from the customer. If the customer paid the entire 500 they owed to us before and we wrote it off, then the amount for the two journal entries here would be 500. Now, how do we estimate the percentage of receivables that are going to be uncollectible? One of the best ways, instead of just coming up with one number, companies put together a schedule that's called aging schedule. So they make their accounts receivable and write it based on how long it's been outstanding, how long have the customer haven't paid us yet. So in this case, the accounts receivable for this company, a new company, is 39,600 at the end of this period. And when we age it, some customers just bought the stuff, and some customers' accounts receivable been outstanding for 1 to 30 days, another customers between 31 and 60 days, and so forth. Now, in the past, based on the experience, 40% of the customers that owe us for more than 90 days will not pay their balance. So 1,900 times 40% is 760. Whereas those customers that just bought their merchandise on credit from us in the past, only 2% of it haven't paid us. So therefore, 2% times 27,000 is 540. We do that for each column. Then at the end, we add up the result of our multiplication, 540 plus 228 plus 300 plus 400 plus 760 becomes the ending balance of the allowance for doubtful account at the end of the current period. Now, most of the time, allowance for doubtful account at the end of last period has a balance in it. So, for example, if the balance is credit balance as of last period, and we want the ending balance for this period to be $2,228, we need adjusting entry. For how much? From the difference of the ending balance and the beginning balance. So in this case, 1,700. But what if we have a different scenario and the beginning balance of allowance for doubtful account is a debit instead of credit, and the ending balance we want to achieve this quarter or this month, this period, this year is $2,228. Now, the adjusting entries amount is different. Since the ending balance is $2,228, however, the beginning balance is $500, we need to increase the adjusting entry by the $500 to achieve the ending balance of what we require. Now, that's the end of our discussion for objective number 2. If you guys have any questions, please let me know via Canvas email.